Alright, welcome back. So in this video we're going to be going over dividends. So when a board of directors declares a cash dividend, it authorizes the distribution of cash to stockholders. When the board declares a stock dividend, it authorizes the distribution of its stock. In both cases, declaring a dividend reduces the retained earnings of the corporation. So I want you to pay attention to this. There are two kinds of dividends. We have the cash dividends and we have stock dividends. A cash dividends, you're distributing part of the company's income in the form of cash. In the stock dividends, you're giving the shareholders additional stock. So basically you're not losing any kind of assets because you're not paying any cash. So now let's focus on the cash dividends. A cash distribution of earnings by a corporation to its stockholders is a cash dividend. So whenever a company pays cash to its shareholders, that's what we call it, cash dividends. So although dividends may be paid in other assets, cash dividends are most common. Three conditions for cash dividends are needed. The first thing is sufficient retained earnings. So the company should have enough retained earnings because remember, whenever we are declaring dividends, this is coming from the retained earnings. Then there should be also sufficient cash. So we need to have enough cash, we have to have enough retained earnings balance, and then we need to get a formal action by the board of directors. In other words, there's a formal approval by the board of directors of the company. There must be a sufficient large enough balance in retained earnings to declare a cash dividends. That is, the balance of retained earnings must be large enough so that the dividends does not create a debit balance in the retained earnings account. That's the last thing that we want to do, is that we are going to distribute dividends more than the balance of our retained earnings. Because remember, dividends is the distribution of net income. So retained earnings is the net income that we've been retaining in the business. If we end up distributing more than what we make in net income, then we end up having a debit balance of retained earnings, and that's the worst case scenario. Because the balances of cash and retained earnings are often unrelated, a large retained earnings balance does not mean that there is cash available to pay dividends. And that's another thing that we also have to pay attention to, is that retained earnings and cash, there's no match between them. We might have a lot of cash, but it's all borrowed money, or we can have retained earnings, but it's not in the form of cash because we have some other forms of assets. So we need to make sure that we have enough retained earnings and enough cash. 3 dates included in a dividends announcement, and these are the date of declaration, date of record, and date of payment. From the accounting perspective, only the first and the last dates are the most important dates. Date of record, we don't record journal entries for. So the date of declaration and the date of payments are the dates that we're going to focus on for the sake of journal entries. So we'll see how it works. So the date of declaration is the date the board of directors formally authorizes the payment of the dividends. On this date, the corporation incurs the liability to pay the amount of the dividends. So at the date of declaration, the board of directors would say we're going to pay this amount of money to the shareholders. And by that, they're creating the liabilities. But they don't officially, or they don't literally pay the cash yet. There's a date of payment that's usually after that. The date of record is the date the corporation uses to determine which stockholders would receive the dividends. So the date of record is an important date for the shareholders because if they own the stock at that date, then they are eligible to receive the dividends. They have the right to receive the dividends. So during the period of time between the date of declaration and the date of record, the stock price is coded as selling with dividends. In other words, you're going to buy it and you're going to get the dividends. This means that any investors purchasing the stock before the date of record would receive the dividends. The date of payment is the date of the corporation will pay the dividends to the stockholders who own the stock on the date of record. During the period of time between the record date and the payment date, the stock price is coded as selling X dividends. This means that since the date of record has passed, any new investors would not receive the dividends, even though at the date of payments they were the owners of the stock. So let's see this example. Assume that on October 1st, Hyber Corporation declares the following cash dividends with a date of record of November 10th and a date of payment of December 2nd. So we have 3 dates here. October 1st, that's the declaration date. November 10th is the date of record. December 2nd is the payment date. And we have preferred stock, 100 par, 5,000 shares outstanding, and we have common stock, $10 par, 100,000 shares outstanding, and the dividends per share is $2.50 for the preferred stock and 30 cents for the common stock, for a total of 42,500. So on October 1st, which is the date of declaration, Hyber Corporation records the following entry. They're going to debit cash dividends, and by the way, that's just like you're saying dividends, which is 42,500. And then you credit cash dividends payable, which is a liability account, for 42,500. On November 10th, which is the date of record, no journal entry is necessary at this date, merely because this is the date that determines which stockholders would receive the dividends. And there is nothing for us on the company side to record. On December 2nd, which is the date of payment, Hyber Corporation records the payment of the dividends, and that would be by debiting the cash dividends payable that was credited on October 1st, so we get rid of the liability, we don't have this liability anymore, and then we credit cash because we paid the cash dividends. Now let's talk about stock dividends. So stock dividends is a distribution of shares of stock to stockholders. Stock dividends are normally declared only on common stock and issued to common stockholders. Stock dividends affects only stockholders' equity. And because of that, if a company doesn't want or doesn't have enough cash, but they have enough retained earnings, they can do this. They can distribute stock dividends. In reality, my personal analysis of stock dividends is that the company is not really paying any kind of dividends. And for the shareholders, again, they're not going to get any kind of benefit. They're getting more dividends, or they're going to own more stock, but they're going to get diluted because the company would issue more stock and it's the same pie, and I'm getting like a larger piece, but the pie it's the same. It's like, or actually the pie, like relatively speaking to the size of the pie, it's the same. So the amount of stock dividends is transferred from retained earnings to the paid-in capital. So the amount transferred is normally the fair value, which is the market price of the shares issued in the stock dividends. So technically, the way I look at it is that we transfer the value of retained earnings to paid-in capital. So moving it from one equity account to another equity account. So let's see this example. Assume that the stockholders' equity account of Hendricks Corporation as of December 15 are as follows. So on common, they have common stock of $20 par, 2,000 shares issued for a total of 40 million. And actually it's 2 million shares issued for a total of 40 million. And we have paid-in capital excessive par, which is the common stock, for 9,000 or 9 million. And then we have retained earnings for 26,600,000. On December 15th, Hendricks Corporation declares a stock dividends of 5% or 100,000 shares for, and how we got that is the 2 million shares that are outstanding multiplied by the 5%, and that would be issued on January 10th to stockholders of record on December 31st. The market price of the stock on December 15th is $31 per share. So let's see the journal entry for that. So the entry to record the stock dividend would be debiting stock dividends and then crediting stock dividends distributable, and that's on December 15th. We didn't distribute it yet. And then we also record the paid-in capital in excess of par. Remember, the market price was $31 and we issued 100,000 shares. So we take the 100,000 multiplied by the 31, and that would be 3.1 million for the stock dividends. But the company stock had $20 par, so we have to record the stock dividend distributable based on the par value. So we take the 100,000 multiplied by 20, and that's $2 million. And the paid-in capital in excess of par for common stock would be the leftover or the difference, or it's a plug-in amount, which is $1,100,000. So at the end of the accounting period, the stock dividends account is close to retained earnings, and the stock dividends distributable and paid-in capital in excess of par for a common stock account are reported in the paid-in capital section of the balance sheet. Therefore, the effect of the preceding stock dividend is to transfer 3.1 million of retained earnings to paid-in capital, which is, as I told you, doesn't really have a huge impact on the company. We're just switching from one equity account to another equity account without affecting the assets. So let's see the stock dividends here, or how they distributed. So on January 10th, when the stock dividends is distributed to stockholders by issuing the 100,000 shares of common stock, the issuance of the stock is recorded by the following entry, where we debit the stock dividend distributable, which is just a liability account, and we credit the common stock because now it's issued for the $2 million. And remember, the paid-in capital in excess of par for common stock has been already recorded, so we don't need to record it again. So stock dividends does not change the assets, liabilities, or total stockholders' equity of a corporation. Likewise, a stock dividends does not change an individual stockholder's proportionate interest or equity in the corporation. So to explain that, assume the stockholder owns 1,000 of the corporation's 10,000 shares outstanding. In other words, 10% of the corporation. If the corporation declares a 6% stock dividends, the stockholders' proportionate interest will not change, and we'll see how's that. So before the stock dividends, the total shares issued were 10,000 shares, and the number of shares owned by this specific stockholder was 1,000. So the proportion ownership was 10%. After the stock dividends, now the total shares issued are 10,600. And I also received 6% stock dividends, so now I own 1,060. If we divide the 1,060 by the 10,600, it's still 10%. So as I told you, it's still the same pie. We just moved part of the equity from one side to another. But my ownership is still 10%. Nothing changed. And I didn't receive any cash. Let me stop here. In the next video, we're going to be talking about stock split.